Hi everyone. So we might get started, just gave a couple of extra minutes for people to jump on, and we might still have some people join us as we start. So for those that don't know me, my name's Kylie and this is Sven next to me. Luckily quarantined together, so can be joining you together today. And we want to welcome you to this webinar based on understanding, I guess, the concepts of blended finance towards building WA's blended finance fund. So before we start, I'd just like to acknowledge the traditional owners of the land, of the many lands, I guess, that we're meeting across today. We're on the land of the Whadjuk Noongar people today. But I want to pay respect to all elders, past and present, of all the lands that we're joining from today. And I also just want to briefly touch on Zoom protocol. So if you can, just keep your mic muted unless you're speaking. And we're happy to use the chat as a bit of a, additional chat happening alongside the webinar. So if you've got questions or comments or links that you want to share, just pop those in the chat and we'll keep an eye on it. And where it makes sense, we'll also just bring that to the attention of whoever's presenting and weave it into the webinar. So today we're going to be talking about the concepts of blended finance. And I suppose, as you would be aware, having registered initially for the workshop, we've split this into two different mechanisms, for want of a better word. So we've got today where we're going to go through some of the concepts of blended finance and some of the examples from other jurisdictions that could be used here. For the workshop that we've got scheduled in August, that will be a follow-on, and the plan there is to use that opportunity to bring in some WA-based examples and to actually workshop out what the financing for those look like. So as you can see on the slide there, we're going to go through what is blended finance, the 4 Ps of blended finance, and some examples from other jurisdictions. So I just want to really encourage you for the funders in the room to be holding on to the knowledge and the kind of concepts we share today so that we can bring them to bear on the workshop that we'll hold later in August, hopefully. Can you go to the next slide, Hannah? Amazing. And so in terms of thinking about the environment that we are in, considering coronavirus, if we step back, fundamentally, I think social enterprise and impact investment is about this idea of sharing power. And it's about creating a new economy or, different layers upon the economy that we have. And I think now more than ever, that's what we need now. I think people have realized that traditional institutions exactly the way that they are right now have not served us particularly well, and nowhere do we see that more than in a crisis. And so how are we starting to reimagine, rethink and regenerate what those institutions look like once we come out on the other side of this? And I think social enterprise and impact investment are two of the concepts that will be critical to be enabling that to happen. And so it's never more important for us to be thinking about how we're building the market for impact investment in Western Australia. And blended finance is, from our perspective, one of the most critical elements that we can be using to create that. So what you see in front of you on the slide is, I guess, a little bit of a vision of what we could see for building the marketplace for impact investment in Western Australia. So in the top right hand corner there, we've got the WA Impact Fund, which has launched and is currently taking expressions of interest. So we've got a $20 million largely debt commercial rate return focused fund. And when we look at the direct other end of the diagram, we've got some collectives. So Impact Collective is a collective of a number of not-for-profits working together to incubate and invest in enterprises at the very seed end side of things. And then we've got this middle piece of the market, which is really where we need to focus on developing out what WA needs. And so what we've got there are largely ambitious at the moment, but we are working towards building a blended finance fund with some foundations that have expressed interest in potentially doing that. And then we kind of really need to be thinking about what seeding impact looks like at the very bottom left-hand corner of the diagram there. So that's really just to locate, I guess, the conversation we want to have today and why blended finance is really important for us to continue to develop the marketplace in WA. And I think there I will hand over to Hannah.
Perfect. Thank you, Kylie. And welcome everyone from afar, from here, from Sydney. Pleasure to virtually meet you in these sort of unprecedented times and take you through a little bit of a teaser and to whet your appetite. So hopefully when we can all see each other again in person, when Sefa and Sefa partnerships come over to Perth, hopefully fingers crossed early August. I'm personally very, very interested in blended finance, and actually had the opportunity to meet with some organizations in San Francisco and in London to really sort of understand how blended finance is already practiced overseas. And obviously it's really, really encouraging to listen to Kylie and Sven and all the work that sort of we are already seeing happening in WA in particular, because we at Sefa feel that there's a lot of potential for blended finance to really shift the dial in terms of impact investing. And it's interesting, obviously Kylie already alluded to that, it's almost like the missing piece in between, it's sort of something that's more commercial impact investing, and then obviously, starting out with sort of very much capability focused, grant focused impact seed, in seeding impact and seeding venture activity sort of at the start. So really I would like to take you through today, I guess, in a way, the different shades of grey of blended finance that sort of really sits in the middle, and look forward to obviously having a discussion later on. So please feel free to put your questions in the chat, and I'm grateful to Kylie and Sven, who will be later on collecting, hopefully in sort of different themes, the questions, so we can have a very as interactive conversation as possible. And also, of course, if there's anything stuff that's unclear already during the presentation, please feel free to put that into the chat. So I would then rely on, Kylie and Sven to potentially sort of just stop me as we go through those couple of slides to clarify anything. But really, kicking off, it's really an understanding in terms of where we are operating across the whole social finance funding spectrum. Now coming to the slide, and obviously there's different words around impact investing, social finance. You might have heard other things like venture philanthropy, and then obviously words like impact first and finance first. And in the end, I think to really probably more simplified in the best way possible for people who are new to this topic, think of it really as like the difference between, or that entire spectrum that sits between pure grant funding and then something that's really purely commercial. So really, when you look at it, everything that is sort of in that impact first social investment in this particular slide is really, trying to encourage organizations to become more independent, become financially more sustainable, start generating some trading revenues, which might allow them to take on other sorts of capital other than grant funding, but obviously is very much away still from, sort of the market-based plus social return, yet alone sort of commercial funding model. So it's really sort of trying to work with different instruments, sort of innovative structures that really build a bridge between pure grant funding and sort of something that's more commercial, whether it's, traditional finance or even impact finance. And I think most importantly, also blended finance continues to use really important tools around capability building. So when we think about overall capacity to really help a purpose-driven organization thrive, yes, it's certainly capital on one side, but really most importantly also capability in terms of strengthening organizational processes and using then those two elements, capital and capability, to really sort of build capacity overall, and then take the journey along sort of that development spectrum that Kylie already alluded to in that first slide. So that's sort of the, I guess, playing field that we collectively call sort of blended finance. And obviously, I think it's interesting to remind ourselves in terms of where that blended finance sits compared to, some people coming more maybe from a financial background, or obviously some of you might be working really on the foundation side to understand sort of how we see blended finance play a really important role. And so in terms of, if we just were to simplify that into like the different development stages of sort of very early stage growth and mature, and obviously on the bottom you can see in the commercial investing landscape, you might have heard of terms sort of angel capital, sort of, venture capital, and then obviously growth capital. And once organizations are ready for mainstream finance to either raise equity in stock markets or get a loan from a bank, that's sort of when, the development curve goes into the more mature stage. But then really, can you turn your, oh, I thought I had turned my video on. Sorry, I'm just going to quickly check. Oh, sorry, I don't know how that, okay, hopefully that'll work now. Sorry about that. Just, bear with me with the IT logistics. Hopefully that video is now recording. And then in terms of then the mirror function on the social enterprise investing landscape, it's really obviously, the straight sort of philanthropic dollar and grant funding that has always been happening in terms of really seeding new ideas. And then the mainstream finance world around, whether that is, banks starting to lend into the impact space, but probably even, the impact funds, even such as Sefa, Social Ventures Australia, IIG. I think it's really sort of in that middle in terms of that growth stage, where there's currently a little bit of a gap in the Australian market in terms of really enabling organizations to take the learnings from the seed stage and sort of, don't fall into, we'll talk about it shortly, about the valley of death in terms of overcome some of the growth challenges. So I think that's a really interesting concept in terms of comparing then, how blended finance fits into that development stage. And I think it's, just as a summary in terms of, I'd say if you're really interested in blended finance, I would really encourage you to go and check out Convergence Finance. It's a global collaboration sort of founded in the US that brings different market players together, that are really working towards making blended finance basically mainstreams. And for them, the three driving characteristics of blended finance transactions are that they're definitely obviously impact sort of is, at the DNA of every single transaction and relationship. So a lot of other impact investors, they're looking at the sustainable development goals as something that they're working towards. And also obviously even though you're looking at a blended finance structure, it might not necessarily mean that you're not seeking a financial return at all, but it might be a more fun, more distinguished financial return that might not be equivalent to a market-based return, might potentially be delayed, might come in different forms, in terms of, a regular sort of income or potentially participation in future growth. So there's a lot more flexibility when it comes to the positive financial return that a blended finance structure has compared to traditional finance. So obviously, and I think again, that's the beauty. There are so many different iterations of actually deploying blended finance that it's pretty much up to each individual investor to craft a structure in close partnership with a for-purpose organization that fits both parties. So there's a lot of flexibility. It's basically, like I mentioned before, a playing field that we can all sort of explore together, of course, keeping in mind the more, replication or, using a similar template, we can achieve certain economies of scale. So obviously that's, keeping that in mind if we are thinking, for example, about creating a blended fund to be a precursor to the WA investment fund. And then I think most importantly also, blended finance a lot of times actually brings also other parties to the table. So similar to pure philanthropic capital often being catalytic, it's also a lot of times that a blended finance transactions unlocks capital from other organizations, whether that's government, other impact investors, or more mainstream investors such as banks. So I think that's really important to keep in mind, that there's a lot of collaboration, a lot of leverage in working out these type of transactions. And, as I said, obviously there's a multitude of different blended finance structures in place, and it really depends on what every transaction partner or whatever in a partnership is agreed. But I took those 4 different ones as sort of the main ones that Convergence has actually put out sort of to the public. So I think it just illustrates it and sort of makes it easier for people to recognize certain structures when people talk about it. And as you can see already sort of on that left-hand side, in terms of obviously blended private capital has, sometimes got those market rate expectations. But then there's also for more catalytic capital, what they have now depicted here as development funding, that is sort of a little bit more concessionary, forgiving, and really is a trigger to catalyze and mobilize that private capital. So when those two elements come together, that's when we talk about those blended finance structures. So the first one is actually, I think, quite a simple one, where basically both parties come together in the same structure. Again, here illustrated through that square of, the structure, where you've got the more commercial / private capital as senior debt or equity, and then there could be like a first loss piece in terms of the more concessional piece put in place. So that could be potentially even just a pure guarantee without, and obviously we'll see that in the second structure. But it could also be, let's say, a structure that has got a concessionary return, but in case that there's a loss, a capital loss, or basically a case of non-repayment in that investment structure, that particular tranche or layer, the black one, would basically take the first hit, and therefore is kind of the more, I guess, risk-seeking, or able to take on more risk than the more commercial capital. And so in the second structure, where definitely it's definitely a guarantee, so not necessarily capital that is sort of deployed in the structure as it is the case in the first one, but it sort of is standing alongside the private capital. So it's a guarantee that's being called upon if there are return losses or capital losses in the overall structure. So it's like a, I guess, standby contingent blended finance structure in that case. And the third one, which I think is really interesting, is I alluded to already earlier, that a lot of times it's not really all about obviously capital. It's also around generating capability within the organization to actually make best use of that capital. So then it's an interesting concept here in terms of having the investment structure potentially being quite commercial, so depicted as, the blue for debt and equity. But alongside is what they call a sort of technical assistance facility, which is basically funding to really provide very specific capability support for that particular social enterprise. So that could be, maybe funding, a review of their governance framework, doing some work around their impact statement, and going through their theory of change to improve some of the social impact reporting they've got. Basically, additional funding that a patient investor like a foundation or philanthropist can contribute towards the overall structure, and that the social enterprise can then make more effective use of those investment funds. And the last, example that Convergence have sort of put out there into the public is what they call like the design, or I guess a precursor grant. And I think to a certain extent, that's really what we're looking to achieve in WA, where basically, following on from the impact collectives, the seed funding potentially through some philanthropic players, we are now looking then as the next precursor, the blended finance fund, before then being able to access some of the funding that's available through the recently launched WA fund. And similar to this is also like a staged approach where, grant funding might be able to fund sort of that, whether it's piloting or developing like a minimum viable product, testing some ideas, that might be higher risk and might not necessarily eventuate in a, sort of commercial return. And then once that's successful, there's almost like this idea of, definitely follow-on investment that gives the certainty to the social entrepreneur. If you've successfully deployed this initial sort of kickoff grant funding, and the business model seems to work, there's a lot of proof of concept, then we've got other capital available that sort of, carries you through the growth stage and enables you to develop the business model further. So I think it's just sort of an idea to give you a flavor of like, what are different structures that are, I guess to a certain extent have already been proven, whether, you know, overseas or here in Australia. And I'll give some more Australian-based examples later. But I think it's a good way of starting to think about, you know, the different roles, different purposes that, you know, the more catalytic, more concessional funding has in partnership with other capital, private impact capital or bank finance. And so, and, you know, I don't, you know, it's not really about the individual sort of, I guess, categories in this picture. It's really more around, you know, illustrating to you, like, for example, you know, organizations like Sefa or our charitable partner, Sefa Partnerships. When we talk about solving the finance puzzle together, like you can imagine, if there is a variety of structures available, it really comes down to every individual partner in a blended finance transaction to decide on terms and conditions and really almost mold a finance solution that might obviously also include other support, wraparound support like capability building. It's really like finding a solution together in partnership. So starting together, you know, with the investor, starting together with the borrower or client or basically target social enterprise, and ultimately going through different iterations of the journey, you know, the journey of sort of solving that finance puzzle together to in the end sort of achieve the outcome, the social impact together. That's a lot of times what blended finance is all about. And so what we've really found, and we've called it the 4 Ps, you know, we weren't able to put it down to 3, but hopefully it's sort of a couple of, I guess, key words that we collectively at Sefa and Sefa Partnerships have found a lot of times recurring when it comes to blended finance, and that are potentially opportunities, but sometimes also challenges as we work through blended finance opportunities in partnership. And so the first one is definitely the pathways that, you know, it is a lot about finding a journey, and it might not be linear. It might potentially even taking a sidestep or like a detour. But a lot of times it is that journey that creates later on, you know, the solution, and it's worth taking that sort of detour to, in the end, together, you know, create the social outcome that we are all looking for. So it is, and it's different pathways that can sort of lead, I guess, to the ultimate outcome. And, you know, and on the next couple of slides, I'll give you some sort of more detailed ideas around like what these different pathways can look like. So it's similar to the, you know, the overview that I already gave with Convergence in terms of that precursor, but really thinking of a pathway that blended finance can deliver in terms of acceleration. So, you know, basically accompanying a venture, a social venture from that seed, the ideation stage, all the way, you know, hopefully not to exit, but certainly to expansion and maturity. So, you know, using different sources of capability, very much closely linked to capability, to then, you know, enable that organization to flourish, you know, deepen their impact, hopefully reach more beneficiaries, to think about like at every point in that, you know, very individual development curve, what's the combination of finance in terms of what is the finance what can the finance require in terms of a return requirement from the organization. In the seed stage or startup, it might be sort of very low, if not no financial return, but then as the organization, you know, sort of grows and is generating more revenue and maybe also a modest profit, it might be able to pay a return to its investors. So I think it's really interesting to see sort of that staged approach, and obviously at the same time always encourage that entrepreneurial thinking, you know, across that business plan for the social venture. And I already alluded to that very early on, which is the sort of valley of death. It's, you know, basically blended finance being really the bridge between, you know, sort of philanthropic seed capital and then more commercial impact finance. And you know, I think we believe, you know, at Sefa, and we've had discussions about that with Impact Seed so many times, that this is really what we call like a wicked challenge, especially here in the Australian market, that there's like a big gap of that growth capital. You know, probably especially obviously that gap that we are looking to close with the WA Blended Finance Fund. You know, we always say, sometimes jokingly, the seed funding is family, fools and friends. And once you've got, that exhausted sort of where's that next stepping stone, almost, diving into that, the acceleration sort of development curve of an enterprise that I've shown just now. But, once organizations go beyond proving their sort of concept or having developed a minimum viable product or service, wanting to test it further, invest, also potentially in backbone infrastructure, so back office systems, also probably capability across the team. But, a lot of those businesses obviously have got marginal profitability. A lot of them are, for example, employment-based, investing heavily in training. And I think in general, we can probably see that a lot of social enterprises don't have the linear profitability that a lot of, sort of just purely for-profit businesses will have. And then if there's, for example, no security available, such as, property, sort of, then a lot of impact investors in the past have shied away from that. So we believe that, collectively, it is really, I guess, a big demand in the market for, working capital, probably in the sort of 50,000 to 250,000, maybe even a little bit more than that, to really help those organizations sort of, get onto that next stepping stone of their individual development curve. So I think that's something that we are really looking forward to sort of exploring in more detail in terms of what could it look like to close that gap. And I think really, interesting enough, very much connected to this thought of, well, filling the gap and, molding a finance and non-financial structure that really supports organizations in the best way we can, is that whole conversation around, well, we call it, I guess, equitable compassion. So having compassion for socially driven businesses that might not be able to pay the same financial sort of market-based returns as other organizations, but are delivering sort of deep social impact. So it comes back to a lot of times that conversation that's going on around impact investing in terms of, it's the best of both worlds. It's market-based returns with social impact, which sometimes, can happen. That's what we call, the people, here at Sefa, we call them sort of the unicorns, I guess. And so the question is like, do we have that many unicorns running around in the purpose-driven market in Australia? Or there are probably also a lot of zebras that, sort of are very all unique in their own right. And they've got a lot of impact, both socially, and probably also ability to pay a financial return. But in terms of the expectation, might be more around what we call the compassionate solutions, whether that, is patient capital in the form of concessionary interest rates, forgivable loans that are revenue based, so don't necessarily have a fixed interest rate, but are more linked to the, I guess, revenue growth and therefore also profitability of a social business. And then sort of more outcomes based solutions, such as the social success note or the benefit outcome linked debt instrument that was recently launched here in Australia. And I'll give a little bit more detail in terms of what these patient capital solutions, sort of really thinking outside the box to create finance structures that are really taking into account the ability, for purpose organization to generate financial returns. And I just want to make a sort of small side bracket for those of you who are working for a PAF or a PUAF, auxiliary fund, in terms of that there are already a lot of guidelines in place from the ATO in terms of how you can use your, I guess, charitable arm, so the grant giving arm, together with the corpus of a PAF or PUAF in a very, I guess, constructive way when it comes to impact investing. So basically it allows you to, for example, deduct concessionary interest rate, or the difference between a concessionary interest rate and a more commercial interest rate, as a donation. It's very much similar to the concept of program-related investments in the US. So basically, there was a lot of work undertaken by Philanthropy Australia, obviously in cooperation with the ATO, in terms of looking to replicate something similar here in Australia. And I think there hasn't been sort of enough use of those, PAF guidelines. A lot of times, obviously, there's not enough guidance and not enough not enough clarity in terms of what that actual legal documentation has to look like. But if you're working for one of those organizations, I would definitely encourage you to look into that in more detail. And we can certainly provide already some, initial documents around that and additional presentations that actually illustrate kind of sort of the use of your corpus slash granting arm when it comes to blended finance in more detail. And so I already alluded to sort of the more innovative sort of outcomes-based structures that I think have got a lot of potential to be a very fair partnership between an investor and a for-purpose organizations, but don't necessarily actually have a government involved. So obviously a lot of people, when you hear in Australia, talk in Australia about outcomes-based mechanisms, a lot of people think about social impact bonds or outcomes-based contracts between social organizations and government. So this is a really good idea around, basically taking government out of the equation and creating sort of like a tripartite or a three-way agreement between a for-purpose organization, a philanthropist, and an investor in the case of the social success note. And so that was something that was trialed between the UBS Optimus Foundation, the Rockefeller Foundation, and a social business. I believe it was a water application sort of provider or distribution network in Africa. And so basically how it works is that there's a lot of alignment between the interests in terms of achieving social outcomes between the purpose organization, the investor, and the foundation. So the contract basically specifies that if the organization, the purpose organization, delivers certain social outcomes, they will have to pay a reduced investment return to the investor. So there's a lot of incentive for that purpose organization to really deliver on those social outcomes. And so for the investor to not necessarily, some investor might have more of a sort of market-based return expectations. It's that third party, it's the foundation that comes into play and says like, well, we'll actually, reward basically both the purpose organization and the investor if certain social outcomes are achieved, because that's the currency. That social outcome is the currency that we are very sort of passionate about as a foundation. And so that contract really aligns the incentives of achieving social outcomes and I guess having that equitable attribution put towards actually achieving social outcomes. So it's almost like instead of in achieving financial outcomes, we acknowledge that you've actually, as a for-purpose organization, achieved those social outcomes, and therefore we are rewarding you with lower financing costs. So it's a really interesting concept of, I think, really balancing social and financial returns. And obviously, post this, doing this first pilot, they are now looking to actually launch it on a more for funds basis in India. And, obviously this is sort of just a taster in terms of this social success note concept. Again, there's more sort of documentation, or we've created like a small one-page sort of primer that, we happily send out if any of you are interested in finding out more about this concept. And so the idea of really finding a good balance between social and financial return is the BOLD contract that was recently launched by Impact Investment Group with the first transaction. And again, it has got the same concept as the social success note, where it really truly aligns the interest of the investor and the for-purpose organization. In this case, there's no philanthropic party involved that sort of creates that top-up payment. If certain social outcomes are achieved both to the for-purpose organization and the investor, which was just the case in the social success note. So here it's sort of more of a two-way contract between the investor and the purpose organization. And basically, in summary, the contract runs like that if the for-purpose organization achieves social outcomes, then for the impact investor, that's sort of the outcome that, collectively those two parties work towards. And so the impact investor says, yep, if you achieve those social outcomes, I acknowledge that, I might only be able to, ask for a certain sort of concessionary financial return. But if the for-purpose organization does not achieve those social outcomes, so it's almost, you can almost then compare it to, I guess, more commercial business, then the impact investor says, well, if you are running more like a commercial business, I'm expecting commercial returns. So it's an interesting sort of I guess, two-way contract to create more alignment. And potentially what they've done here is also actually combined it with a revenue-based repayment to really support organizations in sort of that growth curve. So, it is a lot more flexible, obviously, if you link financial returns to growth of revenue rather than having a fixed interest rate. So you can see, again, there's a lot of sort of flexibility in combining different instruments and I guess different characteristics to create a structure that works best for a particular investor in partnership with a certain for-purpose organization. Because every purpose organization, even if they work in the same industry, they might be set up very differently in terms of, I guess, management, governance, might use maybe a different theory of change or partners. So, obviously, as even though sometimes it takes more time to create sort of a more customized solution, it probably actually means that if you're doing something like that in a blended finance environment, that it's probably more likely basically to succeed if you have really taken the time to understand each other's as partners. And we believe, obviously, the more you do these transactions and the more learnings you have and the more documentation you've got available over time, there will be maybe some efficiencies. But, I think, at the outset, we want to actually sort of prove that the concept of blended finance sort of works. It's not necessarily about sort of the faster, higher, bigger, more. It's creating a lot of times, I think, finance concepts that really work for those purpose-driven organizations, and basically enabling purpose-driven organizations to access capital and capability that otherwise they would never be able to access, because they would be falling into that sort of infamous valley of death or the gap. And this is, another innovative capital structure, just going into the little bit more detail in terms of that first concept that Convergence said, obviously, having the more commercial tranche and the, sort of concessionary tranche taking a little bit more risk. And that's basically the same concept here. Obviously, you can effectively create as many layers as you want. And I think the interesting part around blended finance is that sometimes the labeling doesn't necessarily mean that sort of, the return expectations or the risk profile that a lot of people would attach to that label in, I guess, the more traditional finance world. So, for example, senior debt, and a lot of times is, almost the most, I guess, not almost sometimes even the most expensive mix in the overall blended finance capital structure, whereas normally in the traditional world, you would probably think that's the cheapest source of funding. But a lot of times you need, a grant or sort of a soft loan / concessionary loan as sort of like, I guess, the equity piece. And a lot of times impact finance that might actually provide like a mezzanine or what we call a subordinated. So, I guess higher risk debt position might not be able to charge that same level that normally that higher risk debt would expect to charge in, in a more commercial deal. So I think it really, again, comes down to understanding what are the needs of the for-purpose organization, what is the ability to, pay a financial return, what are the expectations from the different parties? Can there be like a more mainstream party, like a bank being involved that provides, for example, a good tranche of debt, but is maybe more affordable cost than other impact investors would be. But sometimes then also maybe impact investors are saying, no, for us, it's really important to obviously, get this organization onto its growth curve. We are actually willing to take, sub-market returns in order to unlock other capital sort of in that overall capital layer. And so moving on from the 4 Ps of blended finance, so we've left those pathways of, working with different sort of financial instruments and innovative structures. Is in all of that, you might have already obviously a lot of times heard me say, partnerships, relationships, collaboration. So in terms of what makes a blended finance transaction successful, it's really around partnerships, people working together, and a lot of times finding that solution together as part of solving that social finance puzzle. And so a lot of times those partnerships can actually obviously take quite a while. So you get to know each other very well. And just a quick case study here, for example, that Sefa has worked on Nightingale housing. Some of you might have heard of it. They have just broken ground with the Nightingale Fremantle project over in WA. And it's a more affordable housing, I guess, movement that's driven by architects to create, a very sort of community-led housing environment in urban neighborhoods, but very much also focused on a green element. And so it's been quite interesting in terms of how that partnership has evolved. So we've Sefa provided basically the entire debt piece for the first project. So we brought in other impact investors and provided a big chunk of debt that was enabling them to build the first project. But then we've already seen, as projects sort of grew larger, land prices and construction prices have gone up. Sort of that second project, and from then on, we really felt that social finance was, already moving into that space of being that sort of, mezzanine, or I guess the glue, filling the gap between equity that they had raised and then being able to access senior debt from NAB. So there was a lot of, again, that evolution in acceleration that I already mentioned earlier in terms of, blended finance, even though here it's a, you might think it's sort of quite a commercial, I guess, and proposition. It's building housing, it's property, it's security, but it was very important to have that flexibility for Nightingale, for them to, develop their business model and sort of move along. So from the first proof of concept, where basically all the, no bank would touch them. So impact investors provided 100% of the debt, moving on to the, second and third project, where basically, impact and finance, we're doing like sort of sticking that sandwich together, providing the glue between the equity and then inviting, more mainstream debt on board. So I think that's again, a very good example of like how blended finance and impact investors sort of help along that development curve. The third P of blended finance is, for us, it's really passion, where there's people involved, where there's purpose involved. A lot of times it comes, and, the partnerships and the pathways a lot of times take up a lot of energy. It's the passion that is, I guess, one of the key drivers to move forward with a blended finance transactions. Obviously, a lot of times there is, that collective social outcome that all parties agree on. But it's really, I guess, the passion that keeps every party motivated. And while it obviously can be a driver, sometimes I think it can also be a challenging factor, because everybody might have a different personal idea about the how, not necessarily the where to, but, the how do I get there? So the passion element, while is that constant energy and keeping people going, sometimes can also obviously create interesting conversations in terms of what certain structures could look like, how certain things should be done, who should be involved. So I think it's, good to keep in mind that passion, can a lot of times have two sides to the coin. And I think a really interesting example is the first blended finance transaction that Sefa ever did, Tender Funerals. It's basically community-led, very much affordable funeral service, so not-for-profit funeral service that is also very much culturally appropriate. And they basically started the first tender funeral model here in Wollongong, just south of Sydney. And I think it took them 7 years in total. And it took us together with Sefa 2 years to get this first blended finance transaction up. So it was basically the first time that a Sefa loan was combined with a pure grant from the Vincent Fairfax Family Foundation. So it's almost, that I guess first example of blended finance, where you've got a more commercial tranche, and then in this case it was basically a tranche that required no financial return, the grant. And then interesting enough, they were also able to use the power of crowdfunding. So additional grant contribution from the community, but really demonstrating the buy-in and the demand that, this sort of startup model was really wanted in the community. And, I have to say, I'm absolutely proud that, they've been operating now for close to 4 years, and they're looking at actually franchising tender funerals across Australia. I think they're actually already talking to a community group in Perth to replicate sort of that model. And we at the moment working under the assumption that, given that it's a startup, that we will probably need like a blended capital model, again, working with crowdfunding and philanthropic grant contributions to get such a tender funerals up and running.
Hey everyone, we're just trying to get.
Can you hear me?
Great.
Yeah,
Yep.
sorry,
Yep.
I don't know. That must have been because I got a call. I'll backtrack a couple of sentences. Sorry about that. Technology. So what I was saying in terms of that persistence is obviously really, the first couple of points that are raised in terms of finding pathways that might not be linear. You're working with a lot of partners. A lot of those partners have different passions that they bring to the table. So in terms of a lot of times that can obviously take a long time in terms of, that persistence that's really required to bring the transaction home. And I mentioned tender funerals was sort of 2 years in the making. With Sefa, in total took them 7 years. We've worked on another blended transaction for 4 years. We've got one that's 4.5 years and still in the making. And obviously, don't be scared. It's not like sort of full time, but sometimes you have to bring the different puzzle pieces together. It might be, let's say, a government grant contribution that you're waiting for. Then maybe sometimes it's a development application that's not that smooth, or the organization, needs to raise some crowdfunding. A lot of times as time goes on, the budget shifts. So you've got a new gap to fill, and have to think about, again, creatively, what are the different puzzle pieces and tranches that we can bring to the table. But I think, the persist, and that's actually, I didn't realize, obviously had already here the arts case study, the New South Wales one here that took us 4 years. And you can see just from the pie chart in terms of what are the different puzzle pieces in terms of shopfront. Our client contributed 5% through their cash reserves. We were able to, again, bring Vincent Fairfax Family Foundation on board. There was a Sefa loan that we have sort of sized based on what we believe was reasonable for them to, to contribute, to be able to service in terms of financial return and repayment. And there were really other grant contributions through federal, state funding, also club and industry grants. So you can imagine, trying to bring all these different partners sort of along the journey, along the pathway, obviously takes definitely that persistence and discipline to move forward. And I think now to basically, to take action from here and think about, who you can invest in, we like to apply sort of the 5 C's of investing with a community organization. The most important is probably the character. It's the people that you're working with, the people that are driving the purpose organization, but also the business model forward. And then it's obviously other elements like capacity, which is really for us the capability also that lies in the systems, the backbone of the organization, government, strong independence governance frameworks. It's this third C, conditions, and obviously that's really kind of where I think blended finance sort of comes to the forefront in terms of, agreeing what are the conditions of investment, what is the type of investment, is there a return expectation, is there a specific social impact reporting requirement, how long will the investment be for? And linked to that, will there be collateral taken? So collateral being like security, which obviously, might only be as part of a loan. And then really the capital is, again, very much closely linked to those conditions and the actual structure of a blended finance transaction. It's sort of the capital that is required, obviously the budget, which is sort of the, I guess, sources of funds, which might come from different contributing partners, might have different risk appetite, different, return requirements, different sort of, whether it's a first loss or, seniority and sort of that, what we call the cash, the waterfall of, who potentially takes a loss first or who gets repaid first. But most importantly, it's also the uses of the funds. So making sure that there's enough capital to pay for the overall project, probably build in a contingency as well, and work through scenarios like, worst case, do we have enough money to see us through? And linked to that, in terms of taking action from here, it's really important to look at that investment readiness as well. And it's probably very similar to that fourth concept that Convergence has on their website in terms of those precursor grants and, sort of that design piece in terms of, well, before I'm ready to take on investment in a structure, whether that is concessionary, might even involve additional capability building alongside it. But what do I need to do? Is my organization actually ready to take on capital and actively deploy it towards my purpose? So the whole concept of investment readiness and actually consciously investing in, investment is, I think, another sort of area that there's a lot of potential in Australia, and where, we would hope a lot more people, and especially also foundations, come to the table to actually invest in that investment readiness, to, allow organizations to access different resources to actually build up the capability to then make best use of the capital. And I think especially in this rapidly changing environment, COVID-19, the whole crisis has really shown us that obviously it is capital is one thing, but there's also a lot of work to be done in terms of, well, how can we adapt to ensure that we are future-proofing our business model and continue to successfully deliver into the future. So it's, again, really trying to build and connect capability and capital that we collectively basically define as capacity building here at Sefa and Sefa Partnership. And at the same time, always making sure that obviously we keep the social outcomes sort of as the North Star, and, the achievement at the end, and at the end of the work that we are underdoing. So we believe that at the moment, there's obviously a lot of capability building required to adapt, restructure, and prepare for the current demand and future demand, which is probably going to be sometimes increased for certain business models and social impact models, but also potentially might actually change. The demand of tomorrow might not be the same demand as it is now, because our ways of living and our ways of doing things might have changed. So actually helping organizations sort of adapt with their business model, there's probably a lot of investment through capability building that is needed. And then, linked to that, the capital, the actual, sort of financial contribution to actually help them build, probably a lot of times, now that we're doing everything virtual around the technological, but also the human infrastructure. So creating the workforce that is able sort of to transition to the new ways of doing things post-crisis, and, ultimately build out sort of a very effective delivery framework. So we believe that overall the impact, that we could achieve with blended finance, especially in sort of this rapidly changing environment, is really around community businesses, social enterprises that might even be sort of place-based, and sort of create, I guess, the resilience, to be able to operate into the future, and probably very much be focused on employment. Given that at the moment so many people are obviously primarily affected on the employment side by this current crisis. So effectively help build the future workforce of tomorrow, but using a social enterprise model and working that out and delivering it. And so last but not least, what I would like to leave you with, and it's the question is like, is this the fifth P, or is it just a separate P? I mean, overall, it's really a lot of times patience that's required, and sort of somebody once asked this question to the room, well, how do you eat an elephant? Well, you take, one bite at a time, sort of, you start with one limb, and you might have a nibble on, another limb to sort of keep you occupied, but not wanting to necessarily, create necessarily that perfect transaction sort of overnight, but also really see the journey and that collaboration with partners and the pathway as part of, creating already really good outcomes and values for the organization. And probably also a lot of self-reflection and learning for the investor as well. So with this one, we're at the end of sort of the, I guess, formal presentation. And now I'm really excited together with, Sven and Kylie to talk about like how we can even convert that into a little bit more of a reality for WA. Also very happy to share some, more insights in terms of the conversations that I've had from overseas, where they've already started building some of those and actually start operating some of those sort of blended finance funds and models, on a very practical and sort of day-to-day basis. So over to you, Kylie and Sven, to navigate the questions and comments that have hopefully come in.
Thanks, Hannah. That was really great. Not many questions so far, but we will just open it up. If anyone's got questions, if you want to pop them either into the group chat or just raise your hand, and I will do some quick scrolling to see if anyone has a question. None.
None.
Bruce has got one, and then Jason. Sorry, Bruce, you're muted. If you just unmute, yeah.
Can you hear me now? Okay.
Yeah.
I'm the CEO of the Nalama and Yinjabandi Foundation. It's an Aboriginal not-for-profit in Rogan, Western Australia. I was kind of wondering whether Sefa or people working in this space have any collaboration with Indigenous Business Australia, and if so, if that's been successful or not.
So Sefa, actually our largest shareholder is New South Wales Aboriginal Land Council, and through them here in New South Wales, and through them, we've done some work with IBA, and actually one of our clients, sort of taking that next stepping stone, a construction organisation called My Haven up in Cairns, who are training and employment sort of, Indigenous youth as part of the construction. They were actually able to access follow-on investment from IBA. But apart from that, in terms of a sort of, kind of concessionary or sort of really blended approach, we haven't done anything with them sort of in particular, but, obviously very keen sort of to explore that further.
Yeah, good. I was wondering about, because, we have a bit of trouble with the relevance of that organisation. I kind of think it's a place where old bank managers go to die, but so I was kind of hoping for that they might have been more proactive than we've had experience with. But I guess if we keep staying on their case, hopefully they can only improve.
So if you don't mind, I might jump in and add a little bit to that. So they've sort of been investing in the other end of the spectrum recently. So they've now had 4 cohorts go through, which is around developing social enterprise from scratch. So I think there's about 18 or 20 people who've been through that from right around Australia, and they've partnered with an organisation called the Difference Incubator to do that. Where I haven't seen them move yet is really around actually working with existing organisations. So they've identified, to the best of my knowledge, the need to invest in capability, but they're still struggling in that same place, which is that catalytic capital out of early stage and into sort of growth and maturity. And then there's the next layer on that is how do you work with entrepreneurship, so within existing organisations to sort of unlock or transform, to get outside of the rigidity of how things have been, I guess, been running on the tracks to date. So there's definitely people within there who are building their knowledge and capability around social enterprise, but that hasn't, I believe, hugely transferred into capital investment yet. I know that they have been up to Broome. There was one that they were looking at investment in up there about 6-8 months ago, but I'm not quite sure where that's landed. And if you're interested in speaking to some of those partner organisations, I know a couple of them, so really happy to make those introductions.
And Bruce, we've also been in contact with First Nations Capital and the kind of work they're starting to look at doing here too. So I don't know if you're connected with them, but we can, First Australians Capital, sorry, we can make a connection.
Sorry, who was that? Hi.
First Australians capital.
Oh, okay. Right, yeah. Good.
And then
as well.
And then, yeah, exactly, ILSC, so they've now rebranded because they've got the S, the C, so Indigenous Land Sea Corporation, ILSC.
Yeah.
So they've even, I think they've gone beyond piloting sort of impact investing to actually investing into some of the resources. So I think they've got now a full-time resource who's particularly, basically trying to coordinate impact investing in partnership with other partners. And obviously they're a big sort of philanthropic contributor. So I think we are currently already looking at a couple of blended opportunities with them. So it's interesting sort of to see that they're ramping up their activities, but also their willingness to invest both on the capability side, but then also on the capital side. So happy to make an introduction there as well.
Thanks, Hannah. And Bruce will connect you. We can do that follow-up offline. Jason, I'll go back to you for your question.
I guess thanks for the presentation. It was fantastic. We do a lot of advisory work with, and I sit on a couple of boards of not-for-profits, and I guess what we seem to come up with against in a lot of the time in this space is just the cost of sale almost of pulling together these types of projects, and particularly when the perceived risk in these in the early stage of these ideas evolving is quite high. I'm intrigued as to where you did touch on the part of the potential role for public partnership might be to help build the business case and the strategic focus that you need going into pulling these projects together. And we certainly struggle with that in WA. A lot of the support is really only interested in the capital investment, not necessarily in the planning and the strategy. I'm just interested in different parts of Australia or elsewhere how that's overcome more specifically.
Yeah, no, I mean, really good question. I mean, at the moment, obviously, there's the public fund available called the Growth Grant, which is sort of the, I guess, follow-on vehicle from, the Growth Grant that was, I think, kickstarted by the NAB Foundation. And so the Department of Social Services has made available $7 million to be invested into investment readiness and sort of contract readiness, sort of mirroring the similar UK fund that was there. But this fund in particular is really focused on accessing capital. So it has to be some sort of form of capital with a financial return, or at least repayable capital. There was previously another iteration, which, the Discovery Grant, which was a lot more to, I think, Jason, what you alluded to in terms of building that, sort of being the precursor to actually taking on investment, sort of refining a business model, strengthening capability, maybe testing a couple of assumptions to then, give the organization confidence that, if they take on investment, they're hopefully sort of on the right track. So that sort of Discovery Grant, which Philanthropy Australia basically created through bringing in a couple of foundations to put that capital. And I think it was the NAB Foundation that again matched that capital. In this instance, it wasn't necessarily sort of the public that was there. But I think the concept of doing this sort of trial, test and learn, or, the discovery journey. I mean, in the UK, there is something called, I think it was called the Reach Fund, or Big Lottery. The National Lottery in the UK has definitely heavily invested into and that's sort of, I guess, a quasi-public arm. They have heavily invested into investment readiness and, the whole capability building. And I think what would be really interesting to see, given that the Growth Grant is still running for, I think, maybe now 1.5 years or so, in the current light, where people potentially have to tweak their business model, rethink, actually build capability first before taking on new capital. It will be interesting whether they will be able to pivot, the growth grant a little bit to maybe make available these sort of grant tranches for people to actually do exactly what, you've just outlined in terms of building capability and, refining the business model, maybe finding new ways of working. I think that'll be really interesting to see.
I might just hop in here and speak very briefly to the Growth Grant. We've had a couple of EOIs into that, and they're really targeting later stage growth-oriented ventures that I don't want to say that need to prove they don't need the grant anymore, but I think the Growth Grant, the Discovery Grant was a really good grant to have there for early stage ventures. growth grant probably doesn't suit a lot of the ones that projects that we've worked with in WA, but we have spoken with a foundation that's taking a very state-based approach to funding impact investment and social enterprise growth, and they're very keen to see how they can fund investment readiness work here. So hopefully that'll be coming along a little bit later this year.
I think we've seen Victoria also modelled it at that earlier stage, and I've just sent through the link in terms of they were giving out smaller grants, acknowledging to your point that actually the cost, capital costs a lot more for a social enterprise than it does for a regular startup. Both the cost of acquiring expertise, the change in revenue that they're making in order to achieve impact from a profit margin perspective, but also the additional reporting costs that sit within needing a robust theory of change and impact measurement framework. And so Vic and a few other places have sort of trialled on and off smaller grants to help out at an earlier stage, but it's not being done anywhere really well right now.
Thanks, Hannah. And thanks, Jason, for the question. There was a question in the chat, which I'll go to and then throw back to anyone who's left who has one. So Beck James was curious about different organisations that she is aware of and how they sit in terms of the approaches we've talked about. So one of them, I'm not familiar with doorstep dinners, I don't think, but Who Gives a Crap is probably one we're all familiar with. I don't actually know if they've taken on investment or not. Hannah, do either of you guys know anything about that?
Yeah, no, they did come to us a couple of years ago. Back then, we were probably maybe not flexible enough when it came to, creating working capital. And I think they took on some investment from the Difference Incubator and some high net worth. And now obviously they're doing really well. I mean, especially in these times, right? They are now sort of sold out. And so I think they are a really good example of that sort of valley of death when it comes to that growth capital. So they were able to, get some sort of startup funding, but then who's able to give them, let's say 200 or 300, I think at that point, maybe they were only looking for 150,000. So actually not a lot of capital, but for them to basically, use it as part of the inventory and ordering cycle. And I think that's a prime example. Obviously, you can't take security over toilet paper inventory, but not a lot of, impact investors probably, and even now, I think hopefully we are moving currently, for more towards that, to basically see holistically, and when you're lending to people and to a purpose-driven business model. So sometimes security is nice to have on paper as part of the process. I think it's what people are used to and it gives them comfort, but really thinking about, well, what are the actual risks that we can work on with management, but especially that sort of growth capital. That is a really prime example, I think, what is sort of missing in that piece to hop that, from sort of, what is it, the, impact collectives that you've got there onto like a more commercial sort of impact funding mechanism.
Hannah. Hi, Kylie. Do you mind if I just ask a quick question? Hi, Hannah. How are you? Nice to hear you and sort of see you. I'm interested to ask Hannah and anyone really if there have been experiences where the lender has needed to enforce their security. So there's a lot of talk in this space around how to structure, basically how to play the high street game and the finance game, and play the game that money is familiar with, but do it for purpose and do it for social change and do it for impact. And it all looks good and it all sounds good, but I wonder whether or not anyone has actually stepped in and had to enforce their securities.
Yes, we had to. So we obviously see Sefa as effectively in that regard a commercial lender. We are probably still today the commercial lender when it comes to our interest rates. So we've had 2 cases where we stepped in. Interesting enough, they were the first two loans that we ever wrote. Both loans were due to fraud, so criminal activity by management. We recovered all of the funding for the first loan, but the second one, we've literally just basically made a decision to write off the whole loan like 1 week ago, where after we were already mortgagee in possession for over a year and effectively now released the mortgage. But that was, you know, a very complicated situation where we had taken security over units in a strata complex in Queensland that required 100% of all owners to agree to sell. So there was a lot of, I'd say, sort of anomalies that you wouldn't necessarily have between you know, a borrower and an impact investor. But most importantly, and that's why I made this point around fraud and criminal activity, I think in both cases, Sefa and other impact investors involved, especially also in the first transaction, we tried everything possible to come, you know, have a collective, I guess, a partnership outcome, because normally Sefa would never go into the transaction what we would call like an asset lend. So we are lending money to an organization knowing that the likely source of repayment for us will come from selling that asset or the property. So we always, and you know, we always very much focused on what we call cash flow lending. So the operational revenue generation from the purpose organization will enable them to repay the loan, so that security is always just sort of that alternative exit, sort of, you know, the ultimate emergency exit. And so if we, you know, the idea is always, if the operational cash flow generation doesn't work, that in partnership with management, you would find a good solution. And, you know, normally what you would do, you would obviously not take over security. You would try to sell the, you know, during like a managed sale, as we call it, to the open market. Take your time, let's say, do a marketing campaign, maybe find even a buyer for the property that the for purpose organization can rent it back from, which might be more affordable given that they are potentially actually materializing a lot of equity in the property. But in this case, where we had to enforce all of that, sort of the character element of the 5 C's of investment effectively broke away. And again, to your point, shows you that on paper the security is good, but if you can't, you know, work the security in partnership with your client, if that relationship falls apart, then a lot of times that security comes worthless. And that's something that we've seen sort of in, you know, a lesson learned. So doing that together, hopefully with a partner, you know, with a client, can generate at least, I guess, the best possible outcome, even though it's not, you know, the ideal outcome, but at least there's hopefully that collaboration, transparency in place. Does that help?
Yeah, that's really good. Well done. Good answer. Thank you very much. I didn't realize that you were carrying such raw wounds.
Oh, you know, I mean, I have to say, I can only say I wasn't there when we wrote the loan, but, you know, that loan has been causing troubles for a long time. So I can tell you, I think no bank probably would have, you know, basically being hanging in there. So again, that's, I think, what social impact investors would try and do.
Exactly.
Do every single thing possible, be very patient, wait. But, you know, at some point you just can't anymore, especially obviously once the relationship has broken apart, right? There's no trust left and no communication channel open.
Thanks.
Well, so often it's about the people. It's about the people at the end of the day, beginning first, second and last, and that makes all of the difference. I might just say, can I just throw in one other thing? And my friend Bruce is on the line. It's nice to see you, Bruce. And as many of you will know, I do a lot of work in the Indigenous space, and it's rather challenging because whilst we've seen change at IBA and ILSC and changes in the WA state government, it is necessarily slow, and that's the nature of government. And it's not going to be government that leads the way, and it's not going to be IBA that leads the way. But one of the things that I think Western Australia has missed out on, and this goes to Bruce in particular, is that there are lots of great examples on the East Coast that are not necessarily in the Indigenous space that I think would have application here in WA. And for those who don't know, Bruce is based up in Roebourne, and for example, he and I have spoken at some length about the Roebourne local store, about food supply and food security, and trying to find effective ways to enable the community to eat healthy and eat regularly and eat local and not have to travel to Karratha, which today is something that can't be done. And that remains a challenge, and I know it's something that NIFL has looked at in the past. But there are plenty of tremendous examples of initiatives around that food security at a very base level. And I sort of throw out that challenge to everyone on the call today to look at something like that Roebourne local store solution and see whether we can't come up with solutions, because it fits that social enterprise model so nicely, because there's a cash flow there. people need to eat, people need to buy food and supplies. And it sort of breaks our heart that there isn't something more innovative and more innovative solutions in that space.
Thanks, Adam. Good comment and question. And thank you, Hannah, good answer. Has anyone else got a question? No? Okay. Well, if there's no more questions, I might draw it to a close there. Thank you all for participating, and we will get out the slides, hopefully the recording, if tech has been kind to us, and probably a copy of the chat and maybe some additional readings for you all. And I will also send the link for those of you who are coming from the funder investor side of things, a link to the workshop in August. And I'll put in that email, but I'll also invite anyone who's not a funder investor, because we obviously opened out the webinar given it was a different kind of format. So if you're an enterprise, maybe we can talk to Hannah and Hannah about having an enterprise focused workshop in August as well. So I will follow all that up, but thank you everyone, and have a good rest of the day.
Thank you.
Thank
Bye.
you. Stay
Bye.
well. Bye.